This video explains the proposals for recognition, measurement and disclosure of revenue from grants and donations, included in INPAG, Section 23, Part 1. In INPAG, the term grant is used to include both grants and donations. The aim of this video is to make the proposals accessible to a broad range of stakeholders, to stimulate valuable feedback. There are 3 videos relating to revenue in this series, and we recommend that you watch them in the order shown. Firstly, the video called Common Model for Grants and Donations explains the approach and terminology used for both revenue and expenses. Another video called Donations in Kind explains exceptions to the revenue model and disclosure requirements for non-cash donations. There are links to these videos in the YouTube description below. Exposure Draft 2 covers recognition of revenue, that is, when revenue should be shown in the financial statements. It also covers measurement, that is, how much or at what amount a transaction should be valued. Exposure Draft 2 does not include guidance about where revenue is presented on the face of the financial statements. Guidance about the overall format of the Statement of Income and Expenses was shared in Exposure Draft 1. That included proposals for row headings in relation to revenue, and a columnar presentation for funds with restrictions and funds without restrictions. Guidance on fund accounting will be issued in Exposure Draft 3, including whether revenue from a particular grant or donation is presented as funds with restrictions or funds without restrictions. NPOs receive revenue from a range of different types of grants and donations. For accounting purposes, these are classified as one of 2 types of arrangement, either an enforceable grant arrangement, an EGA, or an other funding arrangement, an OFA. We have created a decision tree to help users know which type of revenue they have and what the accounting treatment should be. The first question is whether there is an agreement with the grant provider that includes any terms that affect how the NPO can use the resources. NPOs sometimes receive grants without an agreement being in place, such as general donations in support of the NPO's overall mission. Where the answer to this question is no, either because there is no agreement, or because the agreement does not affect how the NPO can use the resources, the NPO has an other funding arrangement, an OFA. In this case, the NPO recognizes revenue when it controls the resources, which will usually be when it receives them. If the answer to the question is yes, the NPO will need to determine the nature of the agreement, to decide whether or not it meets the criteria to be an enforceable grant arrangement, or EGA. The key question is whether both the grant provider and the grant recipient have both rights and obligations, enforceable through legal or equivalent means. This is covered in more detail in the separate video on the common terms and model. If the answer to this question is no, then the NPO again has an OFA, even if there are constraints on the use of the funds. Any constraints in the agreement do not affect when the revenue is recognized. This is because, at the point that the revenue is received, the constraints are expected to be met, and importantly, have not been breached at this point. However, any subsequent breaches of the constraints by the NPO may give rise to a liability for the NPO at that date. For example, imagine a grant that has constraints, in that it can only be used on the objective of providing education. It is only if the NPO uses the funds for a different purpose that it might have a liability to make repayment to the grant provider. Where both the grant provider and the grant recipient have both rights and obligations, enforceable through legal or equivalent means, the NPO has an enforceable grant arrangement, an EGA. In this case, the NPO will need to identify its enforceable grant obligations, or EGOs, and recognize revenue as each EGO is met, using a 5-step model. We will first look at EGAs, to make clear the difference between EGOs and constraints. So, let's turn now to the 5-step model used in accounting for enforceable grant arrangements, or EGAs. This uses the same general approach for contracts in IFRS for SMEs, and for revenue transactions in IPSAs, but has been modified so that it is relevant for NPOs. The first step is to identify each EGA. In an EGA, both parties to the grant agreement have both rights and obligations, enforceable through legal or equivalent means. An EGA must include at least one enforceable grant obligation, or EGO, for the grant recipient NPO. The second step is to identify each EGO in a grant agreement. In some agreements, there may be a single EGO. In other agreements, there may be several. EGOs include obligations to achieve a desired outcome, obligations to carry out a specified activity, obligations to use distinct resources, such as goods and services, cash or other assets internally for a specified purpose, or obligations to transfer resources to service recipients. Step 3 is to determine the transaction amount. This is the total grant amount that the NPO expects to receive. Determining this amount will usually be straightforward unless the grant includes variable amounts, which we will discuss later. Step 4 is to allocate the transaction amount across the various EGOs. This isn't necessary where there is only one EGO, and INPAG includes simplified guidance for these cases. Where a grant agreement includes more than one EGO, the grant amount is allocated in proportion to the standalone value of each of the EGOs. The standalone value of an EGO is the cost the NPO expects to incur in satisfying that EGO. This includes staff costs as well as purchases and indirect costs. For example, if an NPO expected it would cost $500 to satisfy EGO A and $1,000 to satisfy EGO B, it would allocate 1/3 of the grant to EGO A and 2/3 to EGO B. Adjustments will be required if the grant is only intended to cover part of the cost of satisfying an EGO. This will typically be based on the amount or percentage set out in the EGA. The final step, Step 5, is to recognize the revenue allocated to each EGO as that EGO is satisfied. NPOs will need to understand how to measure this. An EGO could be satisfied at a single point in time. For example, if a grant arrangement requires an NPO to deliver one training course on one day, the EGO would be satisfied when the NPO delivered the course. Other EGOs may be satisfied over time. For example, if a grant arrangement requires an NPO to deliver a training course over a number of months, it is necessary to measure progress in order to determine how much revenue should be recognized and when. Progress towards satisfying the EGO can be measured using output or input methods. An example of an output method would be how many training sessions have been delivered compared to the total number. Input methods would include the staff costs or number of staff hours spent in delivering the training sessions compared to the budget. Because revenue is recognized as EGOs are satisfied, there are likely to be timing differences between when an NPO recognizes revenue and when it receives the grant. This will result in either an asset or a liability being recognized. The first scenario is where the NPO satisfies the EGO before it receives the grant. When the NPO satisfies the EGO, it will recognize both revenue and an asset. The asset represents the NPO's entitlement to receive the grant. When the grant is received, this asset will be derecognized and the cash recorded. The second scenario is where the NPO satisfies the EGO after it has received the grant. In this case, the NPO recognizes cash and a liability when it receives the grant. The liability represents the NPO's requirement to satisfy the EGO. Once the NPO has satisfied the EGO, it will recognize the grant revenue and derecognize the liability. Sometimes, there will be an agreement to modify an EGA. This could involve a change in the scope of the agreement, changing the amount, or both. If there is a change of scope, this will likely result in a change to the EGOs. If the grant amount changes, the total revenue recognized by the NPO will change. The timing of revenue recognition may also change. The accounting for the modification depends on whether the EGOs satisfied at the date of the modification are distinct from those remaining to be satisfied. Where they are distinct, the modification is accounted for as a new EGA that replaces the remaining part of the original agreement. In some cases, the NPO may account for the modification as a new EGA that supplements the existing agreement. Where the EGOs are not distinct, the modification is accounted for as if it was part of the original EGA. The NPO will update its estimates of the grant amount and the percentage of EGOs satisfied accordingly. The total grant amount may include variable elements such as penalties or incentives. In such circumstances, the NPO will need to estimate how these variable elements will affect the total grant amount. When allocating the grant amount to EGOs, the variable elements are only allocated to those EGOs to which the variable elements apply. As circumstances change, the estimates of the variable amounts are updated to reflect whether the penalties or incentives are more or less likely to arise. This may mean adjusting revenue already recognized. A capital grant is when an EGA requires the NPO to acquire or construct a non-current asset that it will then control. The approach to recognizing revenue involving a capital grant is the same as with any other grant revenue. The key challenge for the NPO is to identify the individual EGOs that determine when revenue should be recognized. If the EGA covers both the construction of the asset and its subsequent use, then these will always be separate EGOs. The same principles apply to multi-year grants, which are those that require EGOs to be satisfied, or amounts to be received, over more than one reporting period. Revenue is recognized when EGOs are satisfied. This applies whether the related grant receivable is due in the current year or in a future year. One point is worthy of note: in cases where both the satisfaction of the EGO and the receipt of the grant will only occur in a future year, then no revenue, asset or liability is recognized in the current year. Now let's look at the accounting requirements for OFAs. An OFA can be any grant or donation to an NPO that is not an enforceable grant arrangement. OFAs include situations where there is no written agreement, for example where supporters make regular donations to be used for the NPO's mission in general. It would also include circumstances where there is a formal written agreement, but which does not include an EGO. For OFAs, entitlement to the income is not dependent on the successful completion of any particular outcomes or activities, even if mentioned in an agreement, and the NPO recognizes revenue as soon as it controls the resources. That said, NPOs would still be expected to use the resources within any constraints, if present in an agreement. Recognition will usually be when the NPO receives the resources. However, it may need to recognize revenue earlier, if it has entered into an agreement with the grant provider, and has a right to receive the resources before the funding is provided. Revenue is measured at the fair value of the resources received or receivable. In most cases, the resources will be in cash, and the NPO will record revenue at the amount of cash received. Determining fair value will be more difficult for non-cash donations. INPAG includes some exceptions to this model for recognizing revenue from donations in kind, which is covered in a separate video. An OFA may include constraints on the NPO's use of the resources provided. These constraints could be fairly high level, such as the overall purpose of the grant, a region where resources should be applied, or a time period in which resources must be used. There could also be more specific constraints, for example, through referencing expected activities or a budget. Practically, there is likely to be a spectrum between very high-level constraints through to those that are more detailed. Even where constraints are very detailed or specific, if they exist as part of an agreement that does not meet the criteria for being an enforceable grant arrangement, they cannot be EGOs. Generally, constraints within an OFA will not create a present obligation for the NPO because they lack the enforceability that is required to be an EGO. These constraints do not therefore affect the recognition of revenue. At a future date, an NPO might fail to satisfy the constraints in an arrangement. For example, the NPO may have used the resources on an activity outside of the constraint given. At this point, the NPO will have an obligation to make good its failure. This might be an obligation to provide a refund to the donor, or some other obligation specified in the agreement. When it comes to disclosures, the requirements depend on the type of arrangement. For OFAs, revenue recognition is straightforward, so the disclosures focus on understanding the source of the revenue. Revenue from OFAs needs to be disaggregated between cash received, gifts in kind, and services in kind. Additional information is required about donations in kind, which are covered in a separate video. For EGAs, the disclosure requirements focus on how EGOs are satisfied, including significant payment terms. Information is also required about unsatisfied EGOs, and how EGOs are measured when they are satisfied over time. A breakdown of EGA receivables, EGA assets, and EGA liabilities is required, along with details of any impairment of grants. This video has highlighted the key issues in recognizing and measuring revenue from grants. The recognition model hinges on whether a grant is an EGA or an OFA. When the grant is an EGA, revenue is recognized as the NPO satisfies its EGOs, which may not be at the same time as it receives the grant from the donor. Where a grant is an OFA, revenue is usually recognized when the funds are received. Different disclosure requirements apply to the two different types of grant. We look forward to hearing your feedback on the proposals in Exposure Draft 2. The invitation to comment includes specific questions on the proposals explained in this video. To respond, visit www.ifr4npo.org/haveyoursay. Download a template response document and upload your completed response or comment letter. Responses must be in English. The deadline is the 15th of March 2024.